Assalamualaikum and hello everyone. This is the fourth presentation on Mfrs 138 that is on intangible assets. And in this session, we are going to focus on indefinite useful life and test for impairment. For your information, intangible asset with indefinite useful life should not be amortized. However, the impairment test must be done by the company, the reporting entity, by comparing the carrying amount and its recoverable amount annually and whenever there is an indication of impairment, meaning that frequently if there is an indication of impairment, even if you have done it annually. So on subsequent measurement, what has to be done is the asset must be reviewed on a regular basis to ensure that the carrying amount are not in excess of the recoverable amount. However, what you need to identify is that if there is an impairment loss that need to be made, that is only the case where the carrying amount are in excess of the recoverable amount. However, if the carrying amount is still less than the recoverable amount, there is no need for impairment. So carrying amount is in excess, therefore there is a need for impairment to be done. This is accounted for as per Mfrs 116 similarly. However, the accounting standards on impairment is actually Mfrs 136, impairment of asset. What is the accounting treatment for impairment loss? It depends on the subsequent measurement model that has been chosen by the company. If the cost model is being used, a write-down of the carrying value, which is called the impairment loss, and the write-down of the carrying value to the recoverable amount will be charged immediately in the statement of profit or loss. So this, for example, if the impairment loss is 100,000, it will be debited directly to the statement of profit or loss. IL is impairment loss, so 100,000. And it will be credited to the accumulated impairment loss, 100,000. This is very simple. Under the second model, which is the revaluation model, a little bit of focus need to be made under revaluation model. To the extent that impairment loss reverses previous revaluation surplus, it should be first charged directly against the surplus. Let's say if you have the impairment loss is 100,000, so if there is the asset revaluation reserve balance, let's say of 150,000, so you should charge directly against the asset revaluation reserve that impairment loss of, let's say, 100,000 in case revaluation model is being adopted, and that will be credited to the accumulated impairment loss with the 100,000 as well. Okay, that is if the revaluation balance or the revaluation surplus balance is enough to cover. However, if the revaluation surplus is not enough to cover the impairment loss, it should be charged, the difference should be charged to the profit or loss. So if, let's say, the impairment loss was just 100,000 and the asset revaluation reserve balance there is just 50,000, for example. If it's 50,000, only 50,000 will be charged to the asset revaluation reserve, and remaining will be charged to the profit or loss, debited as similar to the cost model. But you need to always check what are the previous revaluation surplus balance. Should there be any previous revaluation surplus, that is the case. However, if there is none, it should be charged directly against the profit or loss. even if under revaluation model. Let's say there is no revaluation surplus balance, it should be directly charged against the profit or loss, even for revaluation model. So let's look at one example here. This is an example that will illustrate initial recognition, measurement, and subsequent measurement for cost model. We start off with cost model, and this is for cost model that has infinite useful life. So the beginning of the year was 1st of January 2020, and the acquisition was for a franchise, which is a separate acquisition that is done by Kopi Cafe, and that is to operate Mr. Kopi Tarik, which is a kiosk for 50,000. So this is the cost, the purchase price. The franchise will last for 8 years, so this is the finite useful life. And upon acquisition, these are the costs that are being incurred. So what you need to check is either the cost will be capitalized or will be expense off. Either you need to expense off or you need to capitalize. You can only capitalize if that fulfill the recognition criteria. So in the previous lecture, for example, you have been informed that if it's a training cost, that is not to be capitalized. MFRS 138 does not allow this to happen. It prohibits. So this one will be expense off. However, the legal cost to register the franchise is to be capitalized. This is the cost necessary to which is under directly attributable costs. You need that to prepare the asset, intangible asset, for its intended use. Salaries to the staff. Salaries are the operating expenses. Salaries that you paid to the staff should be expense off. So these two will be expense off. So you cannot capitalize as an asset or as an intangible asset. Then you have further information here that the product has grown steadily throughout 2020. 2019, this should be 2020. Okay, there's some typo there, just make some correction. The company claimed that its name has contributed to the tremendous increase in sales and wishes to incorporate this good name. And according to them, that good name can be valued at 30,000. So that good name is a goodwill. And remember, in our previous session, I've already informed you that internally generated goodwill will not be recognized as an intangible asset. It is prohibited under MFRS 138 because it is not separable and cannot be distinguished from the cost of running the business as a whole. So this 30,000 shouldn't be recognized. Right, so you are asked to explain the accounting treatment. Even if you are asked to explain the accounting treatment, I have also provided some journal entry answer if you would check it later in the slide. So let's look at the accounting treatment and look at the year that you are asked to do so, 31st of December 2020. So this is the year end. So what is the accounting treatment for the franchise? It will be recognized as intangible asset. Remember, it was acquired on 1st of January 2020. So it's a separate acquisition, and that is also meeting the recognition criteria. So the definition of non-monetary asset, identifiable non-monetary asset, has been met, and also the details on in that definition that meets the recognition criteria of identifiable control over resources and able to generate the future economic benefits. So you need to mention that, and it is measured at 56,800. So it is the legal cost plus the purchase price. So since the franchise has finite useful life, remember, for finite useful life, amortization must be charged, and it should be charged against the useful life of 8 years. So that's this is the calculation. So it's 7,100, and that will be charged in the SOFP in the year incurred. So as at 31st of December 2020, that is the amortization. That is the first year amortization, and in that year, that franchise will now be carried at 51,700, which is the cost less the accumulated amortization, 7,100. And this is actually the explanation for initial recognition, this part, the first paragraph here. And this is the explanation for subsequent measurement using cost model for asset with finite useful life. For the cost of training, this one will not meet the recognition criteria, and I've mentioned it will be expense of, but you need to write proper sentence on that. For the goodwill, that is an internally generated item, so that is prohibited from being recognized. As I mentioned, it cannot be distinguished separately from the cost of running the business as a whole, and that is not an intangible asset. So that was in accordance with paragraph 49 of the standards, where that is not an identifiable resource. This is the journal entry for initial recognition, and then for subsequent measurement. For initial recognition, you need to recognize the acquisition of the franchise. So an intangible asset will be debited, and that is the franchise. You can credit cash, bank, or you can credit payable if that was acquired on credit basis. And as at the end of the year, you were informed that there were training costs. From the question, you are informed that there were costs that has been incurred for the year ended 31st of December 2020 was, if you look at the question here, right, the cost incurred was 31st of December 2020. Okay, that was actually 1st of January 2020. So we need to make some adjustment here. The date should be changed. Okay, let me just do it for you. This should be on 1st of January 2020. Same goes here, 1st of January 2020. And this is the subsequent measurement. This part is the subsequent measurement. And this is initial. The initial recognition is for the first two entry. So this is initial recognition. This is initial recognition. But this is subsequent measurement. So just make that correction, and you should be able to check that. And I'm going to put a different color so that you can differentiate between the two. So the one in blue here is for subsequent measurement. The one in red is for initial recognition and measurement. Okay, this is the effect in the statement of profit or loss, where you have your training expenses, amortization of franchise, and training staff salaries being included as part of admin expenses. So if you look, the training expenses are actually not being capitalized. It is shown as an expense. And for the amortization expense of 7,100, that has been provided by the company. And this is the impact in the statement of financial position, the extract, and you are showing this at the carrying amount. And remember, this is for cost model. Okay, next we go to the next one. This is another example on cost model where there is a review of finite useful life, and this example also has some impairment loss to be adjusted for. Okay, on 1st of January 2000 X4, look at the date. you have acquired a trademark. And the trademark costs 9 million, and there is a legal life, which is the useful life of the asset of 10 years. And later that legal life was being reviewed, and it is expected that on 1st of January 2006, the expected useful life will just be another 3 years. So it has been reviewed, and now the remaining useful life is 3 years. So you are informed that the recoverable amount of the intangible asset on this date, which is on 1st of January 2006, at the beginning of the year, was 6.3 million. And the company adopted the cost model on subsequent measurement. So if you can see here, there is 3 years involved. One is on 1st of January 2000 x4. This is the first year. And then you have 1st of January 2000 x5, which is actually here. This is 1st of January 2000 x5. Another one is the third year, that is 1st of January 2000 x6. So what you need to do is you need to work out the cost, and the cost has been given 9 million. So go and debit the trademark, credit the bank, because this is initial recognition. For the first year, the amortization will be 900,000. 9 million divided by 10. This is not depreciation, this is amortization, and this is the journal entry. So the carrying amount as at 31st of December the first year was 8.1. Remember, you are explaining accounting treatment, but the workings will help you to explain accounting treatment easily. Right, next is the amortization expense. So amortization expense, the second year it was 900,000. If you look at the journal entry is for you to debit the SOFP, which is amortization expense 900,000, credit accumulated amortization 900,000. So the carrying amount will be 7.2 million, which is the previous year carrying amount minus the current year amortization, 7.2. Alternatively, this can also be 9 million minus 1.8. It can also be 9 million minus 1.8 million, which is 9 million is the cost, and 900 plus 900 will give you 1.8. That is the accumulated amortization. So the carrying amount either way will give you the same answer. So if you compare the carrying amount on 31st of January 2000 x6, that was 7.2, and the impairment test was done on 1st of January 2000 x6 as well, and the carrying amount was 6.3 million. 6.3. So if you compare 7.2 with 6.3, you will get 900,000 to be the impairment loss, and that impairment loss under cost model will be debited directly to the profit or loss, 900,000. And you need to take note on when is the date of impairment test. Is it at the beginning of the year or is it at the end of the year? This one is at the beginning of the year. So by the end of the year, you will notice that there is a change in the amortization because the useful life has been reviewed to be 3 years. So now what you will do is you will take 6.3, the recoverable amount, divided by the new useful life, which is 3 years. So the change in the estimated useful life has caused the change in the amortization, and now amortization is no longer 900,000, but it is 2.1 million. And at the end of the year, by the end of the third year, remember there is 3 years here, 3 years, right? 1, 2, and 3, right? 1, 2, 3, because that was for 1st of January 2000 x4 up until 31st of December 2000 x6. We will move on to next part. This is the explanation for what I have just explained. This is the proper explanation and accounting treatment for the first year. This is the first year where you acquire the trademark, and you need to just focus on this. Yeah, my focus is on the useful life and amortization. The first part is on initial recognition. This is what I'm focusing, which is the subsequent measurement. So subsequent measurement, amortization 900,000, and the carrying amount of the trademark was 8.1 for the first year, right? You can check it here. Okay, that was for the first year. For the second year, the amortization is still 900,000, and you are going to mention that the carrying amount at the beginning of the year now is going to be 8.1. At the end of year 4, but beginning of year 5, 1st of January is 8.1. And the amortization expense was the same, 900,000. So this is the second year that you provide amortization, second year. And therefore, the carrying amount at the end of the year will be 7.2. Then you can go on looking at the third year. And the third year is where the impairment has taken place. So beginning of the year, their carrying amount is 7.2. You need to mention. And there was an indication for impairment, as well as there is a change in the remaining useful life from 8 to 3 years. And the impairment test has been conducted, proving that the carrying amount is higher than the recoverable amount of 6.3, and the difference is 900,000 that will be treated as impairment loss. You need to mention all this, and at the end of the year, the carrying amount will be the recoverable amount was to be restated to its recoverable amount. And the new amortization for the year was 2.1. By 31st of December, year 6, this is the carrying amount, and that is the new carrying amount, right? Okay, what we will do now is we are going to look at the following example, and this is an example where you have an asset with indefinite useful life. And if you have an asset with indefinite useful life, this is about a license that was acquired by Skycast for TV shows. They get the permission to be the provider. They work with the content provider, distributor, producers, and creators, and therefore they acquired a license for the variety of TV shows, for the streaming of the varieties of these TV shows, and the license are renewable by every 10 years. And they were later informed that the license were able to generate cash flow for indefinite period. So this is telling you that this is having an indefinite useful life, right? So therefore, what you need to do is to explain the accounting treatment. First, mention for the initial recognition and measurement, right? This is the one. Next is to go and explain about subsequent measurement. So since the asset has indefinite useful life, there will be no amortization. However, you need to mention about the license that need to be tested for impairment, because the Mfrs 138 provides that impairment must be done annually or whenever there is an indication for impairment, even if there is no information about recoverable amount. For asset with indefinite useful life, no amortization, but there should be a test for impairment. There should be impairment loss whenever there is an indication for impairment. Okay, this is another example, which is for revaluation deficit, Labu Sayung. So Labu Sayung operates traditional homestay. So this one, if you go through, you would be able to see that this company acquired a customer lease from another company for 250,000, and there is a finite useful life of 5 years, and the fair value was later determined to be 80,000. So that was happening for a period of 1st January 2000X6 up until 2000X7. This is 1st of January 2000X8, and this is 31st of December X8. So this is for again 3 years. So you need to understand that the revaluation took place somewhere on 31st of December, because you have the word the fair value. Intangible asset also is measured using revaluation model. So you asked to explain the accounting treatment, not in the first year, not here, not here, but here, meaning that in the 3rd year, and also the journal entry for the 3rd year only. Okay. So if you look at the accounting treatment, you should recognize that as an intangible asset. Why? Because it meets the definition and recognition criteria, as well as mentioning what is the initial cost. So the carrying amount of the customer list as at 1st of January. Remember, you need to explain for 31st of December 20X8. So by 1st of January, the carrying amount is 150. Why 150? The cost is 250, but the amortization now has become 100,000. Why 100,000? This is 250,000 divided by 5 times 2. So remember, the useful life just now were informed to be 5 years, and the cost was 250. So you will have that amortization, which is accumulated amortization. So that gives you the carrying amount. For the year ended 31st of December, it has a definite life of 5 years. So for this year, another amortization will be provided, and it will be recognized in the SOFP. And at the end of the year, the accumulated amortization was 150. Remember, earlier it was 100. Now was 150, and the carrying amount was 100,000. Why 100,000? 250 minus 150. And then since the company adopt revaluation model, on the revaluation date, if you look, the fair value is 80,000. So if you compare this 80,000 with 100, you would notice that there is a deficit of 20,000, and that should be directly charged in the SOFP since there is no previous revaluation surplus. So accumulated amortization will have to be eliminated, right? It has to be eliminated, and the customer list in the SOFP as at 31st of December 2000X8 will be 80,000. That is the revalued amount. Okay, these are the initial recognition, initial measurement, subsequent measurement, and also on the treatment for the revaluation model for finite useful life. So this is a journal entry for the first year, for the 3rd year, the amortization, accumulated amortization, and the revaluation deficit. That's it. I will see you, and I will see you in my next video. Thank you for watching. With that, Assalamu alaikum, and have a pleasant day ahead.